Welcome back everyone. In today's episode, I'll be covering mainly two different portions. In the first portion, I'll be covering Micron's earnings, and in the second portion, I'll be covering some quality stocks that have been falling and whether or not they're buys in today's market. So let's take a look at Micron shares over here. The stock is up around 11% today post earnings, and it is basically carrying the entire semiconductor industry. So the stock is currently trading at a 23 times of earnings and around a 7 times forward earnings. So Micron reported their earnings. The earnings was $4.78 as compared to $3.95. Revenue was a huge beat as well. And the most mind-blowing one was actually their forecast next year. So they actually guided a lot higher than what the streets were estimating. I believe it was between 20 and 30% higher. And this is what is leading to this stock price surge in Micron today. And overall, it's bullish for your semiconductor industry next year for companies like ASML, for example, which Micron gets the EUV machines from. So that naturally leads to this question, which is it time for you to buy Micron shares? It seems cheap at around 7 times of earnings. So what you must understand with all these industries, including your commodity industries, is that the entire cycle, the entire industry is made up of cycles. So it's cyclical. And what you must notice over here is when the P ratio is high, it is actually cheap. And when the P ratio is low, it might not be as cheap as what the market is pricing it at. So for example, in I believe 2024, it was at around 136 times of earnings. That should have been a time for you to buy into the shares. And currently now it's trading at a 7 times of forward earnings. So the stock is artificially cheap right now based on P ratio perspective. And what you must understand with all these different cycles is that there are booms as well as busts. So for example, currently we're on this uptrend. We don't know when the uptrend will end. So when we're going up on this uptrend, what happens, what causes the bust to happen is companies like Micron or your different other memory chip companies, they'll try and expand capacity. So they'll order more machines, they'll order more equipment, they'll try and build up more fabs so that they can fulfill the demand that they think can continue for many, many years to come. But when that happens, what results is that all your chip companies or your memory chip companies will suddenly have the supplies coming in all together at the same time. And then what happens as a result of that is that you will suddenly have a supply surge, and then the bust will happen. When there's a supply surge, what happens is your prices will start to fall, and then companies like Micron will suffer, of course. So semiconductor industry is cyclical in general. I'm not bearish on the stock by any means, but what I'm saying over here is that you need to be careful with this cycle over here. Don't be overhyped by the low P ratio. So in your commodity industry, for example, when you have low P ratio, sometimes it means that the stock is actually expensive. I know it sounds a bit counterintuitive, but P ratio is made up of both price as well as earnings. So when earnings are inflated, the stock is probably expensive. When the earnings are depressed, when you have a high P ratio in your commodity industry, I know again it sounds a bit counterintuitive, but the stock may be cheap at those high P ratio levels. It could be the same thing with Micron today, I'm not too sure, but beware of this cyclical industry. Next portion, I'll be covering some stocks that have been falling. The first one is Mercado Libre. This was actually one that was left in my comment section. So the company is currently trading at a 48 times of earnings, at around a 40 times of forward earnings. And this is actually a small little model that I created for Mercado Libre. It's modeling out their revenue over the next few years. And what I got over here based on these estimates and a 25 times price to earnings ratio is around a $3,000 a share in around 2030. So that represents around a 10% CAGR from today's price, which means that the company is around fair value today. So what you must understand from Mercado Libre is that they have two different revenue arms. They have their commerce portion as well as the fintech portion. But the crown jewel for this company is actually their fintech arm. AWS is currently Amazon's crown jewel. It's the portion of the business that is bringing in most of the profits for the company. Similarly, for Mercado Libre, the fintech arm is actually the one that is bringing in the cash. The commerce portion is the one that is losing money for the company. So if you look at the operating margin over the past few years, they actually only turned profitable for this commerce portion last year. So this year it's around 3.1%. And what I did over here was I increased the margins over time until it reached around Amazon's level in around 10 years time. So Amazon's current operating margin from their commerce portion in the US is around 7%. So this was what I modeled it against. And for the fintech portion, margins are relatively high as well, because for Mercado Libre, what they do is they're a bit different from Nubank. So Nubank is the company that is trying to be sort of like a traditional bank, but with some fintech capabilities. Whereas for Mercado Libre, what they're doing is they're trying to appeal to all of the masses. So Mercado Libre, if you were to look at the 9-mile, which is the net interest margin after losses, Mercado Libre's one is actually a lot higher as compared to Nubank. Nubank is closer to around 10%. Mercado Libre is more than double of that. It's around 21% 9-mile. So what Mercado Libre exposes itself to is it exposes itself to risk, because what Mercado Libre is trying to target are your low-end consumers that haven't even tried to create a bank before. So they don't have any sort of bank, they don't have any credit history, and this leads to a higher probability of delinquencies of non-performing loans on Mercado Libre's portion. So when you're trying to assess a company like Mercado Libre, this is what I would check against. So they recently just reported their earnings, and their fintech portfolio is actually increasing by 89% year on year. So the first thing that I would check against is whether or not the provision for doubtful accounts is actually increasing at the same rate as this. And based on what I found, Mercado Libre is actually increasing that portion on par with this credit portfolio increases, so that isn't too bad. And besides that, there are some qualitative indicators that you can check against as well. So first of all is the quality of the assets on the loan book. So quality of the assets is high risk because they lend a lot of money to consumers as well as people without credit history. So that is the problem with the company today. Second of all is the reliability of the funding source and the degree of maturity and currency mismatches versus the asset base. So for Mercado Libre, funding sources shouldn't be a problem because it's internally funded. As for the degree of maturity and currency mismatches, there's no problem as well because they're lending money to people in Latin America. Third of all is the quality of the earnings from non-lending activities. And as you can see over here, majority of the credit and the fintech arm is actually linked to lending activities. So consumer is lending, credit card is lending, merchant is also lending. Of course, the consumer portion has some sort of a transaction fee, and your asset base is also a very small portion only. The majority of this credit portfolio, this credit business over here is actually tied to lending. So that is also another high-risk portion of Mercado Pago. So overall, my assessment for Mercado Libre is that it is a quality business, no doubt. There are growth engines. There are clearly growth engines that will continually push this company in terms of growth. But I think a lot of this is already priced into the market. So the streets are estimating around 20 to 30% increases in terms of commerce revenue over the next 3 years. So majority of that growth is already priced in. And what you need to ask yourself in that respect is, what has Mercado Libre not done yet? And what can Mercado Libre leverage on to beat all these estimates? And so far, I don't think I found anything special with the company yet. Of course, the company can continually grow and reach a point where it is on par with Amazon in the US. But based on what I found, Mercado Libre, number one, the cost of goods is very high for Mercado Libre as compared to companies like C Limited in Latin America. So the cost for delivery is extremely high, which will push down margins in the near future. And second of all is the fintech portion of the business, which I feel a bit uncomfortable with because it is tied to credit lending activities. And it's really hard to assess the credit quality given that they're lending money to people which do not have any sort of credit history. Of course, they're trying to move up market, which is why the 9-mile is dropping over time. So this is their net interest margin after losses. But what the company is doing is they're trying to increase the quality by moving up market. But overall, the customer base is still severely tied to people that are underbanked. And this is a worry for a business like Mercado Libre, especially when there's a macroeconomic event. Next company on this list is Uber. So Uber is currently trading at a 10 times of earnings at around a 23 times of forward earnings. So there's a bit of discrepancy over here. Let me explain to you why this discrepancy occurs. And I know I've seen people online saying that Uber is extremely cheap now at around a 20 times price to free cash flow. But there are a few things that you need to adjust in order for you to find the true price to free cash flow for the company. And I think the numbers that they're quoting is actually a lot more deflated than what it should be. So first thing here, let's take a look at the income statement. There's actually two line items that is distorting this income from the company. So P ratio is price divided by earnings. The earnings is inflated for Uber because of number one, your income tax expense. So they're realizing a lot of their income tax benefits, and this is artificially increasing the net income for the company. Second of all is this line item over here, which is the company's gain and loss on sale of investments. It's basically the unrealized gains from some of their investments into other companies, like for example Grab, which they will have to report as well. Google has something similar to this, but not to the same extent. And for Uber, what you should be doing instead is to use the price to EBIT, which is this one over here. And if you were to go and calculate the price to EBIT, it's actually closer to around a 40 times P ratio, which is a lot higher than what the market's P ratio is suggesting today. Second of all, for Uber, the price to free cash flow is also a lot higher than what a lot of people are suggesting today. So first of all is stock-based compensation, of course. The company issues out a lot of stock-based comp, so it's around 1.37 billion. Second of all is this line item over here, which is accrued insurance reserves. So this is not actual money that the company is collecting, it's basically float for the company. So it's not really assessing the true earnings ability of the company, and you should be adjusting for that line item as well. And if you adjust these two line items over here, the company's price to free cash flow is also closer to around a 40 times, which is a lot higher than what a lot of people are quoting today. So don't be misled by this. I think Uber is a decent company, but the price to free cash flow quoted is a lot lower than what its true value is. So for Uber, I know you have quality investors like, for example, Bill Ackman being extremely bullish on it. You have other YouTubers coming out and saying that the company is a must own. And there is some moats for Uber as well. So first of all is the company's ability to distribute, the company having the fleet, the driver fleet that it currently has, that provides an extreme value proposition for its consumers. But I've actually spoken to a friend that just came back from the US, and this was what I gathered. So first of all is that Waymo is increasing massively. This is statistically, and in the future when your Waymo prices start to fall, when your EVs start to fall in terms of prices, this will further lead consumers towards AVs rather than on your Uber taxis. So of course, Uber has the distribution today. Uber is connecting with all your different other AV companies. But we all know that the big giants, Google as well as Tesla, they're the ones that will be able to take away market share from Uber very easily because they have the ability to distribute to the same extent as what Uber is doing today. So in summary, this is what my friend told me. He said, there's no point sitting in an Uber taxi with a weird Uber driver when you can sit on a Waymo or a Tesla that has no driver in it, that is fully automated, basically at the same price. I don't disagree with him. I think a lot of Uber investors today are underestimating the risk of disruption. Of course, they can benefit by partnering with all your different other AV companies. But Waymo and Tesla, they're on another level in terms of their ability to distribute. I'm sure they'll be able to surpass Uber if they ever wanted to. So this is the terminal risk for the company. But of course, I think the company today, it will grow very strongly over the next few years. I think this AV story will take time for it to come. But in the meantime, I don't think I'll be investing into this one. Last company on this list here is Comcast. So Comcast is not really a high quality company, but it's one worth looking into because this company has a catalyst coming up. They're basically spinning off the portion of the business that is tied to their cable TV network. And they're keeping the portion of the business that is your wireless, your broadband, your streaming, as well as your theme parks. Basically, the higher quality businesses are under Comcast starting next year. So the stock is currently down around, I believe, 20% year to date, currently trading at around a 5 times price to earnings. And just based off of a re-rating thesis, I think the company could easily re-rate back up to a 10 times price to earnings, similar to what other companies are doing, for example, Charter Entertainment, Warner Brothers as well. So for Comcast, this is an interesting one to look at if you're looking for a catalyst play. I hope you guys have found this video useful. Feel free to check out the Substack link in the description below, and I'll see you guys soon.